the recording now. And as soon as the recording becomes available, I will share the link with you via Blackboard as well as on WhatsApp. Right, so let's have a look at CGT. So the first thing that is really important, and I forgot to say this, but as I go through this, you are welcome to post chat questions into the chat box. I will attend to those as we go through. Alternatively, you can just make a note of any question that you might have, and I will address it at the end of the session. So capital gains tax is not a separate tax in the sense that it actually forms part of our normal tax calculation, but we have a different set of rules when we start calculating a capital gain or a capital loss, and those rules are contained within the 8th schedule to the Income Tax Act, and the link between the rules that we use to calculate a capital gain or loss, which we find in the 8th schedule, and then our framework for the calculation of taxable income is section 26A. Section 26A, if you read it, says we will include into taxable income any taxable capital gain. So CGT, or a taxable capital gain, it's one of those things where it actually matters where you put it into the framework. Now, I've said so many times over the past couple of months, and hopefully you would have picked it up in the study guide as well, that you don't have to strictly place all gross income items first in your calculation, and then only after that deal with exemptions. You deal with transactions or amounts as you find them, as long as the principle is applied correctly. In other words, if it's gross income, it has to increase taxable income. If it's an exemption, that means we reduce taxable income. If it's a deduction, it means we reduce taxable income. But Section 18A, which is the special deduction for donations to public benefit organizations, that one is always, whether you are dealing with a natural person or a company, it is always your last deduction in the calculation in your framework. Then, and we will look at this when we do natural persons towards the end of the year, the second last deduction for natural persons is Section 11 capital F, which is our retirement funds deductions. Companies don't have this, so we don't have to worry about that. That means then that for CGT, any taxable capital gain when you are dealing with a natural person is the third last item that you bring into account when calculating your taxable income. And for a company, it will always be the second last inclusion. So for a company, if I do a normal tax calculation and I calculate taxable income, I will always, if it is in the question or scenario, end off with Section 18A, and just before that, it will be a taxable capital gain. I'm just quickly going to mute myself. I just want to address something in the room that I'm in. Okay, I'm back. Books, won't we have problems in future years if we don't follow the prescribed structure? I'm assuming you are referring to the prescribed structure in terms of placing everything under gross income and everything under exempt income. The answer is no. I follow exactly the same process or structure as all of my colleagues in BAC3, PGWGA, as well as in CTA. And this is also the approach that is followed in the professional exams like the ITC. The issue is the last few elements on the framework. So as long as those are always treated, for example, 18A is last, retirement fund deductions for natural persons is second last, and then taxable capital gains is third last. That because the order of those are important because we use certain amounts before then to do their calculation. So as long as that order, the last 3 or 2 ones for a company is correct, you won't have any problems in future. Right. So this is where we find capital gains tax and its impact on our taxable income calculation. I also just want to remind you, and this is specifically going to be so important for you when we get to online test 4, so the big one on the 23rd of October. When we calculate the capital gain or loss, we calculate that capital gain or loss using the rules in the 8th schedule. It is not the same thing as calculating a recoupment or scrapping allowance. They look similar, and you might use the same amounts to do these calculations, but they are definitely not the same thing. So if I calculate recoupment, I have to use section 84A. And section 84A says, listen, take your selling price or proceeds, limit it to your original cost, deduct from that your tax value, and the difference between the two is a recoupment that goes into gross income. If I calculate a scrapping allowance, and on this slide, it's the more comprehensive calculation, but it's essentially, the difference between your proceeds and your tax value. The only difference is that now you go into a negative amount, so you claim a scrapping allowance. Again, that calculation is done in terms of section 11O, the scrapping allowance or disposal allowance. A capital gain or capital loss is calculated using the 8th schedule. So the 8th schedule says you take proceeds, and proceeds has a specific meaning for purposes of capital gains tax. We also know, or you should know at this point, if you've gone through the material in its totality, that any amount that I've already been taxed on, so something that's already been included in gross income, I will not make part of my proceeds. I'll take it out. So, for example, I'll exclude recoupments. Base cost, that is a capital gains tax term, and base cost is determined in terms of paragraph 20 of the 8th schedule, and that is also reduced by amounts if we have already been allowed to claim the deduction in terms of, for example, 11A or 11E, 12C. And a capital gain or loss is calculated as the difference between your proceeds and base costs. And that difference is either going to be a capital gain or a capital loss. Very, very important, and you will see it on that learning notes little block that I've got there. When you are busy with a homework question or in any of the assessments, please make sure that you deal with these calculations separately. In other words, if you've got a capital asset on which you had claimed capital allowances and you dispose of it, first do the recoupment or scrapping allowance calculation, right? Because you're going to do that using the main act rules, and only once you've done that are you now going to go. So for CGT, it's an extra calculation that's going to come in. We were going to calculate the effect of any possible capital gain or loss. Courtney, proceeds for capital gain, loss calc will never be limited to cost? No, because the whole idea behind capital gains tax is to, take that portion that SARS hasn't been able to include in your gross income because it's a recoupment, for example, and now make it subject to tax. So that limitation to original cost is based on what we did for capital allowance purposes. So we are definitely not going to limit our proceeds for CGT to cost. What we can do with proceeds for cost is, for proceeds for CGT is we can reduce it with certain amounts. So if an amount was already subject to tax, like a recoupment, we will exclude it from our proceeds for CGT purposes. Okay. Happy, Courtney? Great. Right. So Then if we go further, before a transaction can be subject to capital gains tax, we have to have what is known as the 4 building blocks of CGT, because if any of these 4 requirements are not present, then there's no capital gains tax that will be applicable, and they are simply asset disposal proceeds based cost. Please make sure that you know what each of these means, or what each of these mean, specifically in terms of, making sure that you know what an asset is. What is an asset, what is not? When is there a disposal? And then the same for proceeds and base cost. Just quickly going to come back because I heard a question. Do we exclude scrapping allowances as well when determining proceeds? And the answer there is no. Proceeds are only reduced with amounts that have already been included in gross income or income. A scrapping allowance is not an inclusion into gross income or income. A scrapping allowance is a deduction, right? So a scrapping allowance will not be deducted from proceeds. It will be deducted when we do our base cost calculation. Because the base cost, for determining base cost, what we do is, we take our acquisition costs, creation costs, all of those things, and then the Act says, okay, but any amount that you've already been allowed to claim as a tax deduction, you have to reduce your base cost with. Now, in the case of a capital asset that qualified for capital allowances, that would be, the actual capital allowance. So, for example, if it's Section 12C, all the allowances that you were entitled to claim. And then if on disposal, you calculate a scrapping allowance, which you are then allowed to claim as a deduction, that scrapping allowance will also have to reduce your base cost because it is an allowance that you've already claimed for normal tax purposes. So scrapping allowances are not, and I'm going to repeat that, okay? Make a note somewhere. That's a very, very good question. Scrapping allowances are not deducted against proceeds for CGT purposes because it's never included in income or gross income. A scrapping allowance will reduce base cost. Happy with that answer? Great. Right. Then, and ladies and gentlemen, I really cannot emphasize enough how important this particular diagram is, because the structure or the order that you follow for determining capital gains tax is very, very important. And it's not a structure or an order or a format that, as an individual, I thought out and said, okay, this is how my students need to calculate this. This order, structure, format, whatever you want to call it, is based upon provisions in the 8th schedule. So it's legislation that tells us, listen, this is how you are going to be dealing with each individual asset, and then ultimately to work towards a taxable capital gain. So step 1 is you will deal with each individual asset that is disposed of separately. So for each individual asset that a taxpayer, which can be a company or a natural person, but each individual asset that they dispose of during the year, you will, for each of these assets, calculate a capital gain or a capital loss, right? Once we've calculated a capital gain or loss, and this is not something that we are going to look at for ETXN 2708 this year, we had to make cuts to the CGT syllabus because of pressure on the program to actually finish. But next year, you will learn all about certain exclusions and limitations and rollovers that could apply, which, for each individual capital gain or capital loss that you calculate, you might have to ignore it. You might have to, set it off against another amount. But for now, The only thing you have to know is that each capital gain or loss, or each individual asset, as they are disposed of, we are going to calculate a capital gain or loss. Once we've calculated the individual capital gains and losses, we're going to add all of those together to get to either a sum of capital gains or a sum of capital losses. Now, if it's a sum of capital gain, or if it's a positive amount at this point in time at step 2, that means, we have a sum of gains. And if it's a negative amount, in other words, we have more capital losses than we have capital gains, then we will have a negative amount at that point. If you're dealing with a natural person, you will then go and take whatever your sum of gains or losses are and reduce it with the annual exclusion to get the aggregate capital gain or aggregate capital loss. Now, I am going to get back to this one because I got a lot of questions on it this week or last week. But take note in that little step 3 block. It doesn't say minus the annual exclusion. It says you reduce with the annual exclusion. So we're going to get back to that one to make sure that you know exactly what is meant. Please note, annual exclusion, it's a fixed yearly amount that all natural persons are entitled to. It not only reduces a sum of gains, it also reduces a sum of losses. And it is not available to companies. It's only natural persons and then special trusts, but special trusts is not in your syllabus. So for your purposes, you just have to know that no companies can qualify for the annual exclusion, only natural persons. So once we've determined our aggregate capital gain or aggregate capital loss, we are then going to check and see whether we have any assessed capital losses from the previous year of assessment. Now, an assessed capital loss is if after you've gone through the entire format, structure, framework for calculating a taxable capital gain, if your answer is not positive but negative, in other words, you're in brackets, you're in a negative amount. An assessed capital loss is always carried forward to your next year of assessment. You are not allowed to take it into account into your framework for calculating taxable income. The only thing that can go into your framework is a taxable capital gain. So once we get to step 4, so we take our aggregate capital gain, aggregate capital loss, and we deduct from that any assessed capital loss from the previous year of assessment. If our answer is positive, we have then what is known as a net capital gain. However, if it is not positive, what we have is a assessed or an assessed capital loss. So if we take so step 4, because I've just popped all of them on now on the screen. So for step 4, what we're going to do, we will take our aggregate capital gain or aggregate capital loss. If there is an assessed capital loss from the previous year of assessment, we will add that to our aggregate capital gain or aggregate capital loss. If our answer is positive, we have a net capital gain and we can go further, right? Because then we can work towards a taxable capital gain. If your answer is negative at this point, then you are in an assessed capital loss position, and that assessed capital loss is carried forward to the next year of assessment. If it's a net capital gain, then we're going to go and depending on the inclusion rate, we're going to take our inclusion rate, we're going to multiply it with a net capital gain, and the answer there is what is known as the taxable capital gain, and it's that taxable capital gain that is then ultimately included in taxable income. So I really want to emphasize the importance of understanding that it is not the sum of gains and losses that go into taxable income. It's not the aggregate capital gain or loss. It's not the net capital gain. It is never, ever, ever in your life the assessed capital loss. we go through all of these steps to ultimately only include a taxable capital gain. That's the only thing that we are allowed or we are required to take into our taxable income calculation. And again, remember that it matters where you put this amount into your framework. For a company, it will always be the second last inclusion, and for a natural person, it will always be the third last amount that we deal with when we do our taxable income calculation using our framework. Okay. I'm just quickly going to stop and check in. Any questions on this diagram? Okay, so just a quick recap on the on some of the concepts. I'm not going to go through all of them again. Make sure you know what is meant with a capital gain and a capital loss. Make sure you know what is meant with sum of capital gains and losses, aggregate capital gains and losses, net capital gains, assessed capital losses. Just on the annual exclusion, in general, for natural persons, it's 40,000 Rand, and that 40,000 Rand has now remained stable for the last 5 years or so, so we haven't had changes in that. The only time that that 40,000 Rand will change is in the year of death of a natural person. In the year of death, that annual exclusion goes up to 300,000 Rand. If you go on with tax next year, you will learn all about the tax consequences at death, because the moment that you die, your death triggers what is known as a deemed disposal for CGT purposes. So SARS works on the assumption that when you die, you are deemed to sell all of your assets at market value, and you then have to do a CGT calculation in the year of death. And in that particular year, then your annual exclusion goes up from 40,000 Rand up to 300,000 Rand. Inclusion rate, if you're a natural person, your inclusion rate, so that percentage that you use and multiply with your net capital gain to get to a taxable capital gain is 40%, and for companies that is 80%. Okay. So please make sure in a question that you know whether you're dealing with a natural person or a company, because natural persons get the annual exclusion and they get the 40% inclusion rate. Companies, no annual exclusion, and their inclusion rate is 80%. Right. What I want to do next, based on some of the questions I got over the last week or so, I just quickly want to work through 2 adapted case studies with you. Now, this is case study 3 and 4 in your study pack and in the study guide that I've adapted, and I will place these notes, so the PowerPoint that I use for our Collaborate session today, on Blackboard, so you can also have a look at those. So we have gains and losses that were derived by an individual during the 2020 year of assessment. Capital gain on the sale of a holiday house of 36,000 Rand, and then the capital loss on the sale of shares of 20,000. And we have to determine the aggregate capital gain or loss for the year of assessment ending 29 Feb. And then in B, how would our answer change if the taxpayer was a company? Okay, so I just quickly want to show you the following. Now remember, I deal with each asset and its disposal individually. Now they've already done the calculation for you, so they've calculated a capital gain and they've calculated a capital loss. The first thing I do is I get my sum of capital gains or sum of capital losses. If I have a capital gain of 36,000 Rand and a capital loss of 20, then the sum of these two is going to be 16,000 Rand. If I'm dealing with a natural person, then the next step is to apply the annual exclusion. Now, the annual exclusion is 40,000 Rand, right? So that's the standard amount that you get every year. But you cannot reduce your sum of capital gains to an amount below zero using the annual exclusion. So what I'm trying to say is, if my sum of capital gains is less than 40,000 Rand, I cannot have an aggregate capital gain of less than zero. So your annual exclusion is always going to be limited to your actual sum of capital gains or sum of capital losses if that particular amount is below 40,000 Rand. I'm going to stop here and check in. Does everybody understand that? Does it make sense? Or is there something that you are wondering about? Great, thank you. So if we look at B, then if it's a company, the effect on the answer will simply be, sum of capital gains is going to be exactly the same, and we're going to get to 16,000 Rand. Then, because we're not dealing with a natural person, there's no annual exclusion available. So the aggregate capital gain in the case of a company is then 16,000 Rand. Meaning it won't be carried over to the next year. Yes, an annual exclusion is you can't do anything with it, going forwards or going backwards. It's 40,000 Rand for that particular year of assessment. If you don't use the entire 40,000 Rand in that year of assessment, then you lose it. And next year, you'll just have another 40,000 Rand that you can, if you do have sum of gains or losses that you will have to apply against, because it's not something you can carry forward or to the next year. Okay, what if there was a sum of capital losses? How would we deal with that? NAO, and that is up next. Okay, so case study 4, again adapted for Blackboard, says Tabu sells 3 assets during the 2020 year of assessment and calculates a sum of capital loss of 75,000 Rand. And we have to calculate the normal tax implications for Tabu. Now, again, if they ask you for normal tax implications or the effect on taxable income, that's exactly the same thing. So if I have a sum of capital losses, that means that my total capital losses from my individual asset I disposed of is greater than any capital gains that I've made. So for a sum of capital losses, I start off with a negative amount, right? So I've got 75,000 Rand negative. Okay, so it's a sum of capital losses. Now the annual exclusion reduces both a sum of capital gains as well as a sum of capital loss. And this is something that you guys have to be very, very careful of. When you are dealing with negative amounts, right, and this is a math principle, so I drew a number line, and let's just quickly think about this in terms of math principles. So I have a number line, I've got 0. Anything to the right of 0 is positive. Anything to the left of 0 means I start working with negative amounts, right? So if I have a sum of capital losses of 75,000 Rand, that means I am negative 75,000, right? To reduce a negative number, I have to take it closer towards 0. And how do I reduce a negative number? I add to it, all right? So to reduce that 75,000 Rand capital loss, okay, I have to add 40,000 Rand to it, okay, because I'm reducing it. If I had said minus 40,000 Rand, yeah, I would have ended up with something, I think it's 100 and, what is it, 105, negative 105,000, which is not the case, because then you're not reducing with 40,000 Rand, right? So if I have a sum of capital losses of 75,000, I reduce that with the annual exclusion, that means I have made my sum of capital losses less, and I am now left with 35,000 Rand. Now, the same principle applies if you were working with a sum of capital gains, right? If you're working with a sum of capital gains, that means you're working with a positive 75,000. To reduce a positive, what do? I minus, okay? And that will bring me to 35. So it's math, okay? It's a basic math principle that if I want to reduce a positive amount, in other words, I want to make it less positive, then I have to deduct. In other words, I minus. If I want to reduce a negative amount, in other words, I want to make it, I should actually put in there, less negative, I want to get it more towards the positive side, I add. In other words, I plus. But I also just quickly want to show you, and I just need to go to my actual, so I'm just quickly going to stop sharing my screen with you. Ziad, if the sum of capital losses was 35,000, would it go to 5,000 or is it limited to 0? Okay, that's exactly what I want to quickly show you. So I'm just quickly going to stop sharing my screen and then just show you how that would change. Okay, so I'm going to share my screen with you again, and I'm just going to change some of the amounts, right? So if we were in a scenario where instead of 75,000 Rand, sum of capital losses, we were in a negative 35,000. So our sum of capital losses were 35,000, and we had to reduce that with an annual exclusion. All right, so annual exclusion is 40,000. You cannot reduce with your annual exclusion to more or less than 0. So your annual exclusion in this case will also be limited to actual. So to answer your question, Ziad, if the sum of capital losses were 35,000, we will limit it to 0. You won't then go into positive 5,000 Rand. All right, so your annual exclusion, if your sum of capital gains or your sum of capital losses are less than 40,000 Rand, you will not go further than 0. Okay. Nao, does that answer the question that you had? Okay, let me just check. Great. Okay, so I just want to share my screen so that we can get back to the presentation again. Right. Okay. So going on, if we talk about calculating a capital gain or loss, and this is just a reminder, I think, at this point in time, you should be relatively comfortable with this. It's basically proceeds less base cost. Again, I want to emphasize the importance of understanding that proceeds for CGT purposes is calculated using the rules in the 8th schedule. It's paragraph 35. Base cost is calculated using the rules in the 8th schedule, which is paragraph 20. If your proceeds are greater than your base cost, you're going to have a capital gain. And if your base cost exceeds your proceeds, you're going to have a capital loss. And we will do this calculation for every single asset that is disposed of and where we have proceeds and base cost. Okay, so that is the what do you call it? The presentation part of today. I'm going to now move over to the question that was posed to me by students. So if you have any other questions, please also feel free to raise them after this. Okay, I'm going to do this. Let me share my screen again. I hope that's the right one. Just want to check what shares. No, this is not the right one. Okay, sorry you guys. I'm having a bit of a technology issue. Okay, hopefully it will work now. Right, so I had a question about one of the examples in the class question for CGT, particularly the one that deals with JSE listed shares. So this is number one in your CGT class question. And I'm going to deal with that question now, Kelly. I just quickly want to go through this one. So we have a taxpayer, a natural person. I don't have the entire question on the screen, who had purchased shares in a JSE listed company 7 years ago for 100,000 Rand. He financed the acquisition of the shares with a loan from a financial institution, and he had incurred 15,000 Rand interest throughout his period of ownership, and he sold the shares on the 1st of December 2019 for proceeds of 200,000 Rand. Now, remember that for CGT to be applicable, I need the 4 building blocks. I need an asset, which I have because I've got shares in a JSE listed company. I have a disposal. It was sold on the 1st of December. And I have proceeds of 200,000 Rand. And I definitely have base cost, but because these are shares that are listed on the JSE, I might have a special inclusion into base cost. So the amounts that are of relevance in determining base cost is going to be the 100,000 Rand and then the 15,000 Rand interest. Okay. Now, let me just quickly chat to you about interest that is incurred when you acquire an asset. Now, when working with interest that is incurred, we have the following principle, and this is in terms of Section 24J and paragraph 20 of the 8th schedule. Now, we don't go into detail with Section 24J, so please don't worry about that section number. But essentially, it boils down to if we incur interest and we want to determine whether it's deductible for normal tax purposes, so deductible in your regular framework, right? Then it is deductible if it's actually incurred for purposes of trade and if it's in the production of income, right? If those two requirements are met, we can usually claim interest as a deduction for normal tax purposes. The problem with the scenario we have over here is we have a natural person that owns shares in a JSE listed company. Now, that usually is not a trade, only a share dealer, somebody that speculates with shares as trading stock, will have a trade if they invest or buy shares in companies. And, the income that you get from dividends is definitely not in the production of income because dividends are usually exempt. So you won't be able to claim, or Rabbi won't be able to claim that 15,000 Rand interest, when calculating taxable income. And what we also have, and Kelly, this links to what you asked, okay? When we look at base cost, we have certain amounts that are specifically included, and we have certain amounts that are specifically excluded, right? And one of the things that are specifically not allowed is borrowing costs or interest, but there is a specific inclusion for certain types of interest. So if you go and look at base cost, at the list of what is included in base cost, and I just quickly want to refer you to the slide in your study pack. And Kelly, this is particularly relevant for your question, right? So on slide number 48 49 and 50 of study pack 12 is listed what amounts are specifically included as base cost and what amounts are specifically excluded or not allowed, and what must you reduce base cost with. So for purposes of this particular case or scenario, what we are allowed to include in base cost is the acquisition or creation costs. Now, how much did it cost this taxpayer to acquire these shares? It was 100,000 Rand. Then, because these are shares that are listed on the JSE, paragraph 20 goes further and says, I will allow you, even though technically you're not allowed to add interest to base cost, if it is interest that was incurred on money that you borrowed to purchase listed shares, I will allow you to add 1/3 of that interest. So if I had incurred 15,000 Rand interest, and remember, nothing of this was deductible in terms of Section 24J or for normal tax purposes, because the moment that you can claim something as a deduction for normal tax purposes, you won't be allowed to add it to base cost anyway. But in this case, we know, this guy wasn't allowed to claim that 15,000 Rand interest. And because it was incurred to purchase listed shares, paragraph 20 says, okay, you can add 1/3 of that interest to base cost. So if your total interest is 15,000 Rand, you can add 5,000 Rand, right? So the effect of this then on our capital gain or loss calculation is we're going to have proceeds of 200,000 Rand and then base cost. And I really want to encourage you to have a look at what the format or structure of my calculation looks like, okay? I deal with the acquisition costs, the 100,000 Rand, and I add to that separately 1/3 of the 15,000 Rand interest with a reason, 1/3 interest because it's listed shares. Those two added together give me my base cost of 105,000 Rand. And then the difference between my 200,000 and my 200,000 proceeds, 105,000 base cost is going to give me a capital gain of 95,000 Rand. Any questions? While I'm waiting, Kelly, I will quickly just share my screen on those base cost and proceeds calculations as well. But is there anybody that has a question specifically relating to this type of scenario or any other type of scenario? Please explain the moving costs in adjustment 5. What is that? What is adjustment 5? Let me just check whether you're referring to transaction 5. Okay, yeah. Right, I'll deal with that. Let me just open up my solution. Okay, so transaction 5 in the adapted class question for CGT deals with an asset that was moved during its period of ownership. So I just quickly want to show you the question. So this taxpayer, what he did was there was a second-hand manufacturing machine that was purchased on the 1st of November 2017 for 300,000 Rand, and it was immediately brought into use. Then in the next year of assessment, so in the second year of ownership, on the 15th of November 2018, 2019. This machine was moved to a second manufacturing site. And then in the 2020 year of assessment, this machine was sold for 350,000 Rand. And the question is, what is the effect of this on our taxable income calculation? Now, if we have a look at this solution, and I just quickly want to make sure that my screen is big enough, and then share with you the solution. Where's the solution? There. Okay. Right. So the issue in this particular question lies with the moving costs, right? So firstly, you can't just jump into CGT immediately or capital gains tax. You firstly have to deal with any capital allowances and or recoupments. So we have this machine that was acquired in the 2018 year of assessment, and we had, it's a manufacturing machine, so we claim section 12C, it's second-hand, so it's 20% per year. So for the 2020 year of assessment, up until the date of disposal, we would have claimed a capital allowance of 60,000 Rand. Then in the 2019 year of assessment, this asset is moved, right? So in the second year of ownership. So I always, if moving costs are not incurred at acquisition, right, please deal with it separately. Okay, just, you know, you do your tax value calculation separately, because you're not going to use the same rates for the original asset that you're going to use for the moving costs. Because if the moving costs are incurred in a later year, you're going to write off the moving cost over the remaining, you know, lifetime or write-off period of the asset, which is not necessarily going to be the same as what 12C says, you know, 20% per year, right? I'm going to get to that question a bit later, the one that was just asked. I just quickly want to run through this. So in the 2019 year of assessment, they incurred moving costs. So, you know, we calculate the tax value of the moving costs. And then there's the disposal. So we calculate a section 84A recoupment. Right now, this is very important. And I really want to encourage you that if there's a lecturer comment on a solution, that you please read through that. Okay. So the issue in this transaction is the moving costs. Okay, so for purposes of the capital allowance, we can technically capitalize the moving costs to the cost of the asset, and then it's written off over the remaining write-off period of the relevant asset. For CGT purposes, you can only add moving costs to base cost if it relates directly to the acquisition of the asset or the disposal of the asset. So if there was moving cost incurred when this asset was purchased, then we wouldn't have had any issues, because we would have added it to cost for capital allowance purposes as well as base cost for CGT purposes. The issue in this particular example is the moving cost was not incurred at acquisition or disposal. It was incurred during the period of ownership. So for the CGT calculation, when we calculate base cost, we will only base it on the original asset. But the problem comes in then that you are going to have to do apportionments, right? So if you go down to the second lecturer comment, this example on moving costs is very technical and it focuses on the exception, right? So the only thing you need to take from this, the following principle: moving costs can only be added to base cost if it relates directly to the acquisition or disposal of an asset. Okay, so I am not going to test you on whether you can apportion proceeds between the original asset and the moving costs. I'm not going to do that. You just have to know that when we deal with moving costs in terms of an asset, only moving costs that have been incurred at acquisition or at disposal can be added to base cost. Moving costs for capital allowances, they're treated differently. Whether you incur it at acquisition and whether you incur it during your period of ownership, your capital allowance section is going to tell you what to do with that. All right. So you can have a look at this particular example, transaction 5. It's simply to illustrate to you, that moving costs can be an issue, but I really don't want you to get stuck on trying to figure it out. Okay. Just the principle is important. Moving costs, unless it's at acquisition or disposal, will not form part of base cost. No, non-tukozo, I'm hoping I'm pronouncing that correctly. Are you happy with that explanation? Okay, while I'm waiting. The second last question there. Ma'am, if they had mentioned that Robbie had received dividends from the shares, would we still account for the JSE listed shares dividend under the exemptions? Will we add the dividends to the base cost of the shares? No, you remember dividends is gross income, right? So if there's dividends that is received, and I just quickly want to go, yeah, okay, so let's just do that. Let's use a blue one. So if they receive dividends, let's say of 10,000 Rand, right? That 10,000 Rand will be included in gross income by virtue of paragraph K of the gross income definition. So even though that amount is exempt, that is not the issue. You are already taxed on the dividend in terms of gross income. And if the amount has already been included in gross income, you are not going to include it as part of your proceeds, and definitely not as part of your base cost, because these dividends are not amounts that are actually incurred. Okay, so no dividends will be added to base cost. You will deal with that dividend like you normally would. You would include it in gross income because it's in terms of paragraph K, and then if it is a dividend paid by a South African company, you will give it the section 10(1)K exemption. Right. Kiamoetse, are you happy with that? Great. Kele, if the interest wasn't incurred to finance the acquisition of the JSE listed shares, will the 1/3 principle still apply? No. So if the interest was incurred to, let's say, finance the acquisition of shares in a private company, then you will not be allowed to add it to your base cost. It is only if it's shares that are listed on the JSE that you will be allowed to add that 1/3 to your base cost. I just quickly want to, because I told you that I would share it. So I just quickly want to share those particular slides with you, just so that you can go and have a look at those. There we go. All right. So I think this is slide number 49. You will also find this in your textbook. But if you look at base cost, these are the amounts that are specifically included in base cost. So, acquisition or creation costs, expenditure that was incurred and directly related to acquisition or disposal. And there you'll see moving costs. And then right at the end, number 7, 1/3 of interest on money borrowed to purchase listed shares. So it has to be listed shares. And then what are specifically excluded? borrowing costs unless it is interest paid on the acquisition of listed shares, because then you can add 1/3. And then there's a whole list of other amounts that will also not be allowed to add to base cost, and certain amounts that will reduce it. For example, amounts that have already been allowed as a deduction for normal tax purposes, like your capital allowances and the Section 11O scrapping allowance. And then, of course, VAT, but we are going to look at VAT and its impact a bit later. Okay. Any more questions on capital gains tax? Okay, if there are no questions on capital gains tax, is there any questions on the class test of Thursday that's coming? Okay. So just before I conclude, we are nearly done with the marking of last week's class test. So I'm hoping to release those marks tomorrow morning together with the solution. And then please remember to make sure that you know exactly how Thursday's class test is going to work, in terms of you're going to have a written component, but then there's also going to be, you have to take your answers and punch it into Blackboard. So there's a written component that you'll upload as your attempt, but you'll use those answers as part of a fill in the blanks. So you have to transfer your answers. Okay, so make sure you understand what's going on there. If you don't, get in touch with me so that we can clarify it for you. And then that's my story for today. Have a lovely day, and yeah, remember to speak up if you need help. Okay, bye you guys.